What is beta coefficient and how does it measure market risk in finance? Imagine trying to predict how a particular stock will move in relation to the overall stock market. This is where the concept of the beta coefficient becomes essential. It is a statistical measure used in finance to understand the sensitivity of an individual asset's returns compared to the returns of the entire market. The market, often represented by a broad index such as the Standard & Poor's 500, serves as the benchmark for this comparison. The beta coefficient is calculated through a process called regression analysis, which examines historical data of the asset's returns against the market's returns over a specific period. The resulting value indicates how much the asset's price tends to change in response to market movements. A beta value of 1 suggests that the asset's price generally moves in line with the market. If the market increases by 10%, the asset is expected to increase by roughly 10% as well. Conversely, a beta of less than 1 indicates that the asset is less volatile than the market, meaning it tends to have smaller price swings. For example, a beta of 0.5 implies that if the market rises or falls by 10%, the asset is likely to move by about 5% in the same direction. A beta greater than 1 signifies higher volatility than the market. An asset with a beta of 1.5, for instance, would typically increase by 15% if the market rises by 10%, but it would also decrease by 15% if the market declines by 10%. This higher sensitivity indicates greater market risk associated with the asset. Investors often use beta to assess the risk level of a particular investment relative to the overall market, helping them make informed decisions aligned with their risk tolerance. In summary, the beta coefficient provides a quantitative measure of how much an asset's returns are expected to fluctuate in response to market movements. It serves as a vital tool for investors seeking to balance their portfolios by understanding the market risk embedded within individual securities. By analyzing beta values, investors can better gauge potential volatility and tailor their investment strategies accordingly.